Hey, we are live. Thank you for joining us. Finally, getting back to these live streams. I love doing these, but I haven't been able to do them in the last couple of months. Been busy with a mastermind group, learning how to, really create that community here on YouTube. But love being back on these live streams because, it just gives us a better face-to-face connection, and love engaging with everyone on the chat here. Excited about today's live stream. It's going to be huge. It's a hugely requested one, and an update to the spreadsheet that I've been working on for like 3 months. Okay, a lot of you in the community, you're going to remember a video I did a few months ago asking what kind of functions you wanted in an investing spreadsheet. And I've been working with the developers for 3 months trying to put this thing together. More than just like a portfolio tracker or an investing spreadsheet, I wanted it to be an intrinsic or a holistic look at your portfolio. Something that's going to help you put together find the gaps and the risks in your portfolio, help you see where maybe you need to add some investments, as well as helping you plan your investing goals, your retirement goals, and and then obviously comparing stocks. That was another very highly requested function that people wanted to see. So love seeing everybody here in the chat. Looks like we're coming through loud and clear, and I want to get started real quick here. Actually, today we're going to start off by featuring 3 community members. 3 people have sent in their portfolios. We're going to use this new spreadsheet to review those portfolios, kind of give you an idea of where the gaps are, where the risks are, and a lot of the things I talked about. And a lot of people sent in their portfolios. Can't do all of them, but I'm going to reply to those emails that I got. But even if you don't get your portfolio reviewed here in the live stream, I think a lot of the things we're going to talk about are going to help you with your portfolio, because what I saw when I looked through the 20 or 30 portfolios that I got on by email is that a lot of the gaps, a lot of the risks were the same throughout. So you're gonna, even if you don't get your portfolio reviewed, you're gonna see a lot of the same things in your own portfolio, in your own investments, and that's gonna help you plan better and find those gaps in your own portfolio. Seeing a lot of people join. Yeah, no bow tie. Nope. Sundays, the live streams, I relax a little bit, take off the bow tie. Still in the bow tie nation, but put those away for today. Good to see everyone. Diego, none your business. Great member of the community. Been in the community for quite a while now. I appreciate that. Scott, Matthew. So we're going to. Hey, deployment in Afghanistan. Hoorah, man. Good. Thank you for your service. Glad you can make it with us here. So we're going to start off with those 3 portfolio reviews, kind of show you around the spreadsheet. If you'd like a copy of the spreadsheet, we've uploaded it as a course to Teachable. I'm going to leave the link in here. So that's going to give you a 57% discount on the upload. Basically, I just priced it so to be able to upkeep the spreadsheet, because we got a couple features on there that I'm going to be upgrading them. Going to be adding new features, and I'm going to be monitoring that spreadsheet every quarter. So I'm adding actually some sector averages that I'm going to show you. Going to help you compare stocks across sectors, something you can't do on any other spreadsheet, any other website, comparing against those website averages. So I'm going to be using that spreadsheet, and then we're going to get into how to invest right now. And there's something in the market lately, the coronavirus. Okay, right? The market is going absolutely batshit crazy. Biggest 1 week drop in history. Okay, market fell into correction territory, 10%. Down 15% from its high the Wednesday before last, in record time. Okay, so obviously on a lot of people's minds, got a lot of comments, a lot of questions about how to invest right now, and we're going to talk about that. We're going to talk about how I'm investing, how I'm positioning, how bad the coronavirus could get for stocks, and then we'll leave time for Q&A. So looks like everybody's getting in, and we are going to get started because we got a lot to talk about, and I want to get to that Q&A section, because that's what I love doing these live streams for, is doing the Q&A, talking with you back and forth, and really being a community like we are here on YouTube. Real quick, I want to highlight some of last week's videos. The videos coming up this week. Last week we started our kind of age-based investing series. We started with millennial investing, so it's the first of 3 video series. We talked about just kind of that millennial group, what's their risk tolerance, what are some of the investments they can look at, and some of that kind of thing. How to plan for that. Friday's video was all about the cost of divorce. I know something that's been requested quite a bit in the comments from people in the community, so I wanted to address that, kind of show you, okay, so what are the costs of divorce, how to get a cheap divorce maybe, if you can go that mediated route, and some of the things you pay after divorce. So not necessarily that investing theme, but really trying to work, trying to help people out in the community that have requested it. When my parents got divorced, I think I shared in the video, when my parents got divorced, they didn't have a whole lot anyway, but my dad, I think he got less than half of half. And he had no money for the rest of his life till he died, and it's just a bad situation all around. I think they could have saved a whole lot of money. They've spent a ton of money on the lawyers, and I just want to help you avoid that. So those two videos last week, if you didn't get those, or if you didn't see those, check those out. Next week, we've got some really great videos. I know you're going to be excited about these. We've got the second in that investing series, Gen X investors. And actually, it's weird that, if you look at the data and look at one of the charts I share in those videos about the average savings for each generation, the millennials are actually doing a little bit better than my own generation. Okay, the Gen Xers falling behind their average savings of about 30,000 for the Gen Xers. So I don't know quite what happened there. Why my generation is so far behind? Maybe it was that. I think it was because we just started investing right around the time that the internet bubble burst. So that was a bad experience. Then we were building our portfolios right during that real estate boom, and then the crash there. So it's set Gen X back quite a bit, even more than us, maybe the boomers and the millennials. So that one's coming on Wednesday. Tomorrow, talking about some income sources you might be able to use to grow your income. Loved doing that one. And then Friday, we got our March dividend update, right? So we're doing best dividend stocks each month to pick, and we're going to update the portfolio on Friday. So I want to get in here. I see a lot of great comments, a lot of great questions in the chat. I want to get to those really quick here. So we're going to fly through these spreadsheet reviews. Talk about how you can find some of the gaps in your own portfolio. Again, if you want to copy this spreadsheet, I've included a link in the comments below, as well as in the chat. It really took a long time to develop this, and we're going to be adding features to it regularly. So really happy how this came out. So our first transition here, our first portfolio I got here was from Kyle W. And Kyle's 19 years old and just started investing this year, but started at 19, which is awesome. That is great to see, Kyle. He's going to be a millionaire easily by the time he's 50. He wants to retire between 50 and 60 age range, and he says he needs about $2,000 monthly to live there. I think that's obviously going to change as you get older, Kyle. You get a family. Obviously, your expenses are going to go up. You're going to need to take care of those. Even as the kids move out, then I think you're going to see that your monthly expenses are going to go up. So when we look at his financial plans, his goals there, I'm going to increase that maybe a little bit to $3,500, maybe $4,000. I don't know where Kyle lives, so maybe his cost of living is quite a bit lower. And he's investing $450 a month. So what we did here is Kyle sent me his portfolio, and I uploaded these already. Basically, I didn't want to spend this whole live chat trying to put people's portfolios in. So basically, what you're going to do, if you download this spreadsheet, you're going to first go to this portfolio tab, and you can put in up to 50 stocks here, stocks, funds, anything listed on the exchanges. You put in the ticker symbol first, right? Put in the ticker symbol first, and it looks like Kyle has 19 stocks here in his portfolio. You're going to put in the number of shares and the price per share you paid on these. And if you bought shares in multiple sections, so say maybe you bought 10 shares one time at $30 a share, and then you waited a little while, bought another 10 shares at $40 a share, then you would just go in here and you put in your 20 total shares, and then do like $35 a share, that average price. Makes it a little bit easier. You can do them on separate lines if you like. There's nothing wrong with that, but there is a limit here to 50 stocks or funds that you put in here. Then what you're going to do is you're going to hit this load stock market data, and what this spreadsheet is going to do, it's pulling from a site called financialmodelingprep.com. Okay, great site to learn financial modeling. They have all the financial statements, everything uploaded on the site, all the ratios and stuff. So it's a great site to pull data from. Okay, a lot of times you'll find sites like Morningstar where they don't adjust the data So some of the PE ratios are off a little bit, and some of the other data is off. Yahoo Finance adjusts the data, but a lot of times it'll get off on its data too. So I found Financial Modeling Prep is really the best site to pull that raw data from. So that's what I did with the spreadsheet. Once you hit that load stock market data, it's going to take between 3 to 5 minutes at the most for most computers to load all this. There's a lot of code happening in the back end here. And it's just going to populate all this other stuff, okay? It's going to populate your asset classes. It's going to do the sectors, the industries here, the current price. And we can scroll over here. It's going to bring in the dividend yield, the market cap, 52-week high, low, beta, price to earnings, and it's going to calculate your portfolio losses and profits here. Now, a couple things I want to highlight on this. If you do use the spreadsheet, and I've got all this on the video how-to for the spreadsheet, so it'll talk you through this. But you're going to want to come through here and make sure these asset classes are right. Sometimes it'll bring in like real estate investment trust. It'll bring in REITs as stock, and you could just change this to real estate, right? Because that's going to be important when we're looking at the portfolio on an entire portfolio perspective. We're going to look at the different assets and the different sectors, and it's really going to help you show where some of the gaps and the risks are in your portfolio. So I've put in, like I said, I already put in all these stocks for Kyle's portfolio. Put in it populated with the sector, the industry. And now one thing I really like, and I really wanted to get in these, in this spreadsheet, was this kind of color-coded and percentage of portfolio thing right here. Okay, this is going to show you, this is going to calculate how much each stock or each fund is as a percentage of your portfolio, right? And then this color-coded index is something I did where it's just going to kind of give you a little warning sign, right, to that. So those of you in the community know I like to keep my stocks at no more than probably about 5-6% of my portfolio, right? That means that any one company doesn't control a huge part of my portfolio or of my net wealth, right? You get a company that is more than 10% of your portfolio, something happens to it and it can destroy your returns for years to come, right? And great companies have fallen on times like that. It doesn't take an Enron or some of these other scams. We all know what happened to GE. We all know what happened to Wells Fargo. Once great companies that people wouldn't think twice about having a lot of money in, really, I mean, have just fallen to almost nothing. And so you really don't want a lot of your portfolio in one particular stock. So what I did here is you're going to see how much each stock is of your portfolio, and from 0 to 3%, it's going to give you a little green here, right? No big deal. It's a pretty small part of your portfolio, and actually leaves room to add more to that stock if you want without bumping into that 5 or 6% range. Anything from if you go to 3 to 5%, it's going to change to yellow here. So still in a pretty safe zone, but getting up there. 5 to 10%, it's going to change to this kind of pinkish color, right? It's getting a little heady there. You might start thinking about cutting back on that position if you can take some profits, or just not increasing that position anymore, right? I love this idea of kind of a color-coded warning index to show you really, when you start getting into that danger territory of stocks. I had a friend of mine that was investing in coal stocks back around 2015, and just chased a stock. It was Peabody Energy, right? BTU. Chased it all the way down, right? He thought coal was going to make the rebound. He thought these stocks were going to come back up, and he just kept adding and adding to his position. And before he knew it, before he even realized it, he had 20-30% of his portfolio in this one stock. And of course, eventually Peabody filed bankruptcy, just completely wiped out his portfolio. About $30,000 ended up costing him. So I love this idea of being able to really get that warning sign on your stocks. Anything over 10%, this is going to change to red here, so that is definitely the warning sign. Now, if it's in something like a fund, then I wouldn't be too worried about it, because that fund is diversified across a lot of companies. So if you're more than 10% in a fund, that's no big deal. What I would say with Kyle here, he has got 20% of his portfolio, it looks like, in 3M. 3M is a great company, huge conglomerate, and they're kind of diversified within the company itself. But I would not suggest having 20% in one single company, okay? It can, the headline risks are just too much that you can run into, and it can really hurt your portfolio. So that's that main portfolio page. And again, this is pulling all of this data, other than you just put in your ticker symbol, the price you paid, and the number of shares you had, and it's going to populate all this data for you. And now that's going to feed into this portfolio overview tab. Okay, and I love this for that big picture view of your portfolio. So many investors, they don't look at their portfolio like this. They get kind of caught, when what we had last week with the big stock market, the correction. They don't know that they don't have any money in bonds or any money in real estate. Really, that diversification you need with your portfolio. So this is going to show you, what percentages of your portfolio you have first here in assets. So Kyle has 95% of his portfolio in stocks, okay, and then just 5% in real estate. Obviously, kind of a danger zone there. He really needs to have a little bit more in bonds, more in real estate, depending on his age. I mean, he's 19, so he can obviously take quite a bit more risk there. But in a time like this, over this last week, that position in bonds, even if it's only 10% of his portfolio, would have really helped him out. It would have smoothed out his losses there, and it would have given him the cash to take advantage of this market and buy in stocks at a lower price. So definitely something that he needs to adjust here. For 19 years old, I mean, I would generally say upwards of around 15%, 20% in real estate, maybe 10% in bonds. He's got a lot of time left, so it's definitely a stock-heavy portfolio, but not nearly 95%. Another thing this is going to show you, this portfolio, is the sector breakdown. So it's going to take all the sectors of your stocks, show them to you here, and it's going to show you compared to what's in the S&P 500, right? So the market weight of those sectors. So, and just another really great way to see how diversified you are, what sectors are maybe a little bit risky for you because you've got so much in that sector. For example, Kyle here has 23% of his portfolio in industrials, right, in the industrial sector, compared to just 9% of that sector represented in the S&P 500. So he's definitely overweight there. Not necessarily a bad thing. He just needs to kind of think about, the stocks he's holding there and the outlook for that sector of the economy. One thing he can do is look at some of these other sectors where he doesn't have nearly as much, right? So technology, he's got only 1% of his portfolio in technology versus 24% compared to the S&P 500. So you might want to add some technology for growth there. Obviously, he's got 0 in consumer cyclical stocks. Very low in a lot of these. In financial services, he might want to add some there as well. Next here, we want to look at this investing goals, and I really liked adding this function to the spreadsheet because most spreadsheets, most investing spreadsheets, you're just going to get a tracker, right? It's going to show you your portfolio, gains and losses on it. That's pretty much about it. It's going to maybe highlight some of the sectors and assets in there, but it's not going to help you actually plan for your goals. So this is why I wanted to add this tab to the spreadsheet. An entire investing goals spreadsheet. You're going to start off by adding your age, the age to retirement, and your monthly investing amount, right? And what this is doing, it's pulling that portfolio information from this portfolio tab, right? It's populating all this other stuff for you. So I put this in for Kyle. He's 19. He says he wants to retire right around 50 to 60, somewhere around there. So we've got him retiring at 55 here with those 36 years left. He's investing $450 a month, and his current portfolio is about $1,400. So, and what this is doing, what I love about this is it's actually taking the asset class breakdown in your current portfolio, right? So for Kyle, it was 95% stocks and 5% real estate. It's taking that, it's putting this monthly invested amount, and it's using historical average returns for these asset classes to estimate your portfolio at retirement, right? A lot of trackers, a lot of portfolio estimators will just use one return, for stocks. So they'll basically say, okay, if you earn 8% for the rest of your time investing, this is what you'll have. What this actually does is it takes how much you have invested in stocks, bonds, and real estate, and shows you, okay, at those historic returns, so about 5% for bonds, 4 or 5% for bonds, 8% for real estate, and maybe about 8 or 9% for stocks. Given how much you're investing in each asset class right now, what can you look at for your portfolio when you retire there? So it's a much more accurate representation, I think, of your estimated portfolio at retirement. And then it's just going to take that 4% of the estimated portfolio and show you kind of what kind of withdrawal income you can get. I went off the 4% because it's kind of a popular financial advisor rule. You can take 4% out of your money out each year out of your portfolio in retirement. fairly safe, not worry about going broke in retirement. So that's what I did here. And a lot of this, what I love about this is you can play around with this, right? So say we look at down here lower, and Kyle figures out, okay, I need 2 million to retire. This isn't going to quite do it. So what can I do here? Maybe I can increase this times to retirement to 38 years. Maybe I can add $50 a month, so I'm investing $500 a month here. And there, he sees, okay, so I'm going to have about 2 million there. So you can kind of play around with the numbers to see, where it gets you and how far you need to go. Next, you look at how much, just finding out how much you need in retirement, right? So Kyle said he only needed 2,000 in retirement. I think that's obviously going to change when he gets a family and starts getting some of those other bills. So I put in $4,500 here. So you put in how your monthly expenses in retirement, just an estimate here, and then for this tax rate, you can go 10%, you can go 15%, you can go whatever you think is realistic. And a lot of that depends on, okay, is most of your investments in a retirement account, so a Roth, IRA, 401k. When you take that money out, other than the Roth, that's tax-free. But when you take out an IRA and a 401k, that's taxed as regular income, right? So regular tax rates. So you got to kind of figure out, okay, what are my income tax rates going to be at that time? Or if your money is coming out of a regular investment account, then that's taxed as capital gains, right? So it's a lower tax rate. So 10, 15% here. I'm going to go ahead and say 15%, and that's going to populate down here. And then Social Security benefits. Right now, average Social Security benefit is $14,000 a year for one person, $28,000 for two. And you can play around with this too. If you don't want to depend on Social Security, then you can put in 0 here and see how much money you need. If you think, okay, well, I'm pretty sure I can get at least one Social Security check between myself and my partner, my wife, then you put that in. And this is just going to take these 3 numbers. It's going to show you how much you need after SSI, right? It's going to need how much you're going to need each year out of your investments to live on in retirement. And of course, then it's going to tell you, how much of a nest egg you need. How much do you need to invest? So, put in 4%, kind of a safe withdrawal rate. You can go as high as 5%. I think is usually not too bad either. And this is just telling Kyle that he needs about $1.2 million by the time he retires here in 38 years. We'll switch this back to 36, which is what he wanted to do. So about 1.2 million. And we could see that, right now he's on track for about 1.6 million. So he's actually doing pretty well there. So now I want to show you this last tab here, and then we'll do those other 2 portfolio reviews. Then get into how to invest during the coronavirus, how to invest right now, and answer all your questions there. But another really cool feature of the spreadsheet is this compare tab, right? So I built this up, and you put in two stocks. So we'll do Nike, and we'll do who's another good one? Netflix, NLFX, right? Netflix. I think that's the symbol for Netflix, right? NLFX. There we go. Hit this compare. And hopefully this doesn't eat up all my bandwidth and kill our live stream. I didn't even think about that before I hit compare. But that'll take, about 2 minutes at the most. And it's going to populate this, again, with that data from financialmodelingprep.com. And what this is doing is, that's not the NFLX, that's what it is, NFLX. That's the Netflix. There we go. Okay, so what it's doing is pulling all that data in these 10 metrics, right? Price to earnings ratio, price to earnings growth, price to sales. These operating measures or these profitability measures like gross margin, operating profit margin, regular just bottom line profit margin. Okay, that's didn't do it there. Let's see what we get with Disney. For some reason, it didn't pull in for the sector average for Netflix. So let's try with Disney. But anyways, pulling in the value for these, so you compare the 2 stocks across each other. But what I love about this, and what you won't find on any other spreadsheet, is it's also going to show you the sector average. Okay, so it's going to show you the price to earnings for all of these operation or these profitability metrics, payout ratio, all this stuff. But I created another spreadsheet, a private spreadsheet that I have on Google Docs, that it pulls from, and I update every 3 months. After earnings, I update the sector average spreadsheet to show you the sector average in all the sectors, right? So not only can you compare these two stocks against each other on these 10 metrics, but you can compare them against the sector averages for these also. Great function, great way to make sure that you're getting the best of breed stocks within each sector. Okay, it's so much more than just picking stocks. Is making sure that you have the stocks that are doing well against their sector, really positioned in their sector to do well. So we're gonna go to the next portfolio because I want to get these done and get on to your questions and how to invest. Who we got next here? Make sure we got Blake is next. So Blake sent in his portfolio. He's got 12 stocks there. Blake is actually a 40-year-old teacher from Kansas, so awesome. Love hearing that. The teachers part of the community. Love the teachers even more so than I think the military, the guys in the military like myself, stuff like that. I mean, teachers, thank you for your service, because I remember what I was like when I was in school, and that was a war zone there. So love seeing the teachers in the community here. Blake says nope, I'm sorry, this is Ryan. Got started off wrong there. There's Ryan. Okay. When you open up the spreadsheet at first, you're going to see this little enable content. Go ahead and get that. There we go. Okay, so this is Ryan. Ryan's a 40-year-old teacher from Kansas. Started investing 3 weeks ago and would like to retire sooner than 65, but he's not quite sure he can do that. Okay, I put in his tickers here, and like I said, he just started investing 3 weeks ago. So he's just got the 8 stocks right now: Appian, Nice, and Nvidia, Square, Ballard, PayPal, Microsoft, and Garmin. Right. Within there, I put in the number of shares he's got and the price per paid, and hit that load stock market data, and that pulled all that data. Now what we can do, we can go over here, and since he's only got 8 stocks, right, and no funds here, then obviously a lot of these stocks are going to be a big part of his portfolio. So obviously this is something he wants to look at. He wants to maybe add some fund exposure there so he can kind of diversify through those funds, but he definitely doesn't want to have 22, 18, 17% of his portfolio in a single stock. Okay, that's definitely, like we talked about, kind of a danger zone area there, because no matter how you feel about these companies, there's always that headline risk, that litigation risk, regulatory risks, all those kind of things that nobody can foresee. Okay, like we said, who would have thought that GE would be a tenth of its value after a few years, or I think it's about 20% of its value. It's fallen by 80%. Great company, historically well managed, that kind of thing, and it couldn't save it. So definitely want to think about adding some funds here, Ryan. Adding some funds, stocks, bonds, and real estate to diversify your portfolio and bring down some of these percentages here. If we go to the portfolio overview tab for Ryan. Again, he's got everything in stocks, 100% in stocks. Really needs to start investing in some of those bond funds, real estate investment trusts, those funds. And you don't even need to get really necessarily complicated on these. You go bond funds like the BLV or the BND are good. Cheap Vanguard bond funds gives you your whole bond exposure in one fund. Really easy to buy. For real estate, buy a few of the REITs. We've covered those on the channel before. And then that VNQ, the Vanguard REIT Index Fund, or the Vanguard REIT Fund, the ETF, gives you all your REITs all in one fund. Really easy to buy. Really easy way to diversify away from stocks here. Okay. There's sector breakdown again. Great way to look, because I don't know if Ryan was aware that he's 87% in technology stocks, but this is really going to show him, okay, you know what, you need to start investing in some of these other industries, finding those best of breed companies, using this stock comparison tab to find those best of breed companies in each sector and add a little bit more exposure to that. He's got some financial services, he's got some industrials here, but really needs to start upping his exposure here. Finally, we'll look at this investing goals tab here. Like I said, he's 47. He wants to retire a little bit earlier. He wants to retire by 65 if he's able, and he's investing about $150 a month. So we do that, and yeah, obviously, he's getting started late, but he's getting started, that's the important part. And this is kind of showing his portfolio at retirement. and estimated monthly withdrawal income. It says he needs $3,500 in retirement. I estimated 10% on taxes and the Social Security benefits. So you can kind of play around with this. This says he needs about $800,000 by retirement to live on that, to live on that 4%, to get that $32,000 or $32,000 a year in retirement to cover his expenses. Now, what he can do, okay, so obviously he's starting late. He wants to retire, within 65, 70 range. Well, let's up this to 20. So let's say he waits till full retirement age at 67. Let's say if he can squeak out maybe another $100, if he can invest $250, and then let's say maybe he can drop his expenses in retirement to $3,250, and we're going to keep the Social Security benefits at $14,000 because I don't know if he's married or single or whatever. So this, if he's taking, we'll say 5%. There. So this, by playing around with the numbers there, we got him down to about $586,000 he needs by retirement, right? And he can just keep on playing around with this a little bit more. Maybe he waits till 60, or he waits till 70, gets a little bit more on that Social Security check, invests, to see if he can go $350. That's at least getting him to $330,000 by retirement. So it's playing around with the numbers a little bit. It's not quite to that 586,000 by retirement, but it's still a decent nest egg to be able to provide for retirement. It's still going to give him an extra $1,100 a month plus Social Security to live on. Okay, last one here. I want to get Blake in here because I told him I'd review his portfolio. And Blake has 35 years to retirement, $3,500 monthly expenses he's expecting, and investing $1,000 a month. He's got these 12 stocks and funds here. So he's got a couple of funds, so I like to see in that. He's got some real estate. He's got the Vanguard Long-Term Bond Index, or the Long-Term Bond Fund there. We'll go over here. And so really he's got some stocks. That's a bond. So he's got 8% in Disney. He's got 9% in Microsoft, so he's got a few stocks that are kind of bumping up against that danger zone for positions. Okay, I love Disney. Huge fan of the Marvel movies, and I think Disney's going to do really well. But they're fighting those streaming wars, and I think the streaming wars are going to be a lot more expensive than people realize, right? So I think that's going to really hit profitability, and I'd really be cautious about having almost 10% in that one company, or in any company really. He's got a couple of reds here, but those are both in funds, so I wouldn't necessarily be worried about that. Again, those funds are diversified within the funds, so not necessarily like he has the 17 or 16% of his wealth in one single company. He's got it in those funds. Looking at the portfolio overview tab here, these assets, and he's actually got it fairly well positioned here. He's got 76% in stocks, 16% in real estate, and 8% in bonds. He's got 35 years left to retirement, so obviously quite a ways there, quite a bit of risk tolerance he's got, and he can be a little bit more stock heavy. I'd like to see maybe the bonds up a little bit, especially what we're looking at right now with the coronavirus. 16% probably isn't bad for real estate. I usually have right around 20, but I'm a little bit older there. For the sector breakdown, he can kind of look through here, and there's a lot of sectors that he has no exposure to. So might want to consider, upping that, especially, financial services, healthcare, two of really the only value sectors right now in the market. Energy, financial services, and healthcare, really the only three sectors that are trading anywhere near their historic price to earnings ratios. And we'll talk more about that next when we talk about how to invest right now in this market. But he's got 16% in consumer cyclical stocks against 10% that's in the S&P 500. He's got 9% in technology. So just something to think about as far as what sectors he's got exposure to, and maybe where he can increase his exposure. Last year, investing goals. So he's about 30 years old. He's got that 35 years to retirement, and he says he's investing $1,000 a month. So actually, what we're looking at here, according to his breakdown in that stocks, bonds, and real estate, he's looking pretty good. He's looking at about $3.2 million over those 35 years if he continues to invest in the same assets, the same asset breakdown, right? and do $1,000 a month. He says he's got about $3,500 expenses in retirement. We estimated just a 10% tax rate here and no Social Security benefits, right? Just be on the safe side, not counting on that Social Security. He's going to need $46,000 a year beyond, well, not counting that Social Security. And at 4% withdrawal, that's only $1.1 million that he needs. So actually, he can kind of play around with this and maybe even retire a little bit early. He could retire at 60 here. He can say, okay, maybe I want to live a little bit higher on the hog here, $4,500 a month. So if he's spending $4,500 a month in retirement, he's going to need $1.5 million, and this is still estimating he's at $2 million. So he's doing pretty well. So that's the spreadsheet. Loved how this came out. Again, I'm going to put a link to the spreadsheet to be able to download your copy. It's in the chat up in the top. It's also going to be in the comment section. I'll leave a comment there with the link to download download your copy of that. Now I want to talk about the market right now. Okay, how are you investing? How am I investing? Kind of walk through some of the things that we're looking at. I know I've got a lot of comments. I know a lot of you want to talk about this. So, as I said, the market just had its worst 1 week drop in history. Okay, dropped 15% from its high previous Wednesday. Actually, if you remember, I had that stock market data video come out the Wednesday before last. I think it was the 19th. Kind of warning people that I thought the coronavirus was going to get a heck of a lot worse. It was really going to start weighing on the market, and better lucky than good anyway. I thought maybe it'd take a little bit longer, but the next day is when the market started falling. Fell 15% from its peak on that Wednesday, and I think it's likely to get much worse. Okay, Asia is in full-blown epidemic mode. Okay, South Korea and Japan, it's just a matter of time before it really takes off in Japan, as dense as the population is there. South Korea, Italy is actually the third largest exposure outside of China. I think they just reported 1,100 cases as of today, and what's crazy about this is how fast it's moving. Okay, Italy just a week and 3 days ago, right? It was the I think February. I want to say February 23rd is when they first started reporting their cases. They had 3 cases of coronavirus. In a week and 3 days, they now have more than 1,100 reported cases of this virus. Okay, and it's not contained. So this is growing at an exponential rate. And even officials from the CDC are saying it's not a matter of if, but a matter of when it takes hold in the U.S. and we get more cases. One thing that I'm kind of watching is, if you've been following the news on the outbreak and testing on it, then most of the U.S. states, most of the states in the U.S. don't even have good test kits, right? They can't do their own testing because of some faulty test kits that they were given. So what they're having to do is they're having to test people and send those results to Atlanta, to the CDC, to get those tests done. Of course, obviously that's taking days to get any kind of results, and those people are back out into the population. What I think you're going to see is the CDC is saying that all the states are going to get their test kits this week by end of Friday. What you're going to see, I think, is once the states actually start testing for this virus, you're going to see how many people are actually infected. Okay, and we're going to get a bump in those cases, and that's going to spook the markets. Okay, that's what I'm expecting anyway. Is that we're going to see this bump. We've already got a few cases. There was actually one death in Washington. I think it was the first death in the U.S. On coronavirus. We've already got cases where it's being transmitted person to person, not necessarily the people that brought it from overseas, but the people that got it right there in the U.S. So I'm thinking this is likely to get much worse before it gets better. Okay, we just saw the China, I want to say the PMI index for China came out. That's the manufacturer's index. Yesterday or last night, fell by the most in history. Okay, 50 it was right above 50 last month, I think, which is the line for contraction or growth, right? Anything over 50 is growth, manufacturing growth, which is obviously something we want to see. Markets were expecting it to drop to 44, so into recession territory for manufacturing activity in China. Dropped to 35. Okay, so much worse than expected. Biggest drop in history that we've seen in that manufacturing index. So I think once these economic data points start coming out, and they're coming out this week and over the next month, we're going to see that this virus is having a much bigger economic effect than anybody is expecting. So we can kind of talk about positioning, where we're at, and how to position for this. If you've been following, those of you in the community know that I've been kind of bearish on the market for the last couple of months anyway. So I was actually in 25% cash. I had 10% covered call options, 20% in bonds. So I was really only about 30% in stocks. So I had that opportunity to take advantage of this, and I shared my thoughts in a blog post, and I'll go ahead and show you this. I didn't want to take the time. I didn't want to take the 2 weeks that it takes to do a video on this. So I'm gonna share this with you. Let's switch over the screens here. Okay, this is My Stock Market Basics. If you don't know, this is a blog I run on investing, and so I did a quick emergency update on what I was doing for the coronavirus scare, and kind of a timeline there. This shows kind of the PE ratios, right? So how expensive were sectors in the market before the virus hit. This is actually about a month old, this data. And you can see, I mean, we were historically expensive in a lot of these sectors. 26% in consumer discretionary, 40% premium on information technology. So the stocks in the IT sector, 40% higher than that longer term average on their PE ratio, right? The only three or four here that were close to their averages really were in energy, which is actually trading at a 15% discount. Industrials here is 11% premium to its long-term averages. Healthcare is 10%, and financials is 8% over that long-term average. So still expensive on a historical basis, the stocks in these sectors, but not so much so that compared to these other sectors. And I'm going to get right back to that when we talk about what stocks am I buying, how am I positioning, and when am I getting back in the markets. So we'll come back down here, and this shows kind of my positions before the coronavirus hit. So 25% in cash, 10% in covered call options, 20% in bonds and P2P loans. I had 15% in real estate and real estate funds, and that 30% in stocks. So it was a good position to be in when it really my stock portfolio actually fell by, I think it was about, well, I mean the market was 15% down. I was about 5% down, right? And that was a lot because a lot of my stocks are higher beta stocks. They're more volatile than the market, so they actually fell more than the market. But because I had so much in cash, I had so much in covered calls, kind of shielded me from a lot of that. Here's what I'm doing though. So we'll share this, and then we'll share some of the stocks that I bought last Friday, and how you might call or how you might get back into this market. So I basically put out this plan. If stocks reach 15% from their peak, so a peak was 33.86 on Wednesday, I think it was the 19th. It was Wednesday before last. If stocks reach 15% or fall 15% from their peak, approximately 28.78 on the S&P 500, then I was going to use 25% of my cash to buy stocks with covered call options against them, right? And this actually triggered on Friday. So the S&P 500 fell 15% from its peak there into correction territory. So I went and bought some stocks. And what this does, though, is I get in on these lower stock prices, but with those covered call options, so I'm selling calls against these stocks, I was able to protect myself from another 5% down, right? So I'm in these stocks. I was able to take advantage of of that drop. But I've still got some downside protection just in case this gets worse, which again, I think it will. Now, the next level here is if stocks reach 25% from their peak, right? So if stocks fall 25% from that 33.86, approximately 25.39 on the S&P 500, then I'm going to use 35% of my remaining cash to buy stocks, right? I'll go back into the market, find the stocks that I like, the funds that I like, and put 35% of my remaining cash into those stocks. If stocks keep falling, and this is the point where I think it might not happen. Okay, this is the point where to go 35% down from its high, that coronavirus, the scare, everything that's happening is going to have to start coming through in layoffs, right? Companies are going to have to start seeing this, start seeing the economic decline, and they're going to start laying off people. And that's what's going to put us into that next recession is higher unemployment, lower consumer spending, and it's going to push us into a technical recession if that happens. Now, I don't know. That wouldn't be my first call, right? I don't necessarily think that companies are going to rush to lay off people and to to push us into that recession. But if it does happen, then I want to be ready for it. Okay, I want to be ready with cash to put back in stocks, take advantage of those lower prices. Now, again, if we don't get to that point, I'm fine with holding some cash. I'm fine with holding more cash than I usually do because, again, stocks are historically expensive. We looked at that chart. Stocks in the technology sector were 40% overvalued when we went into this thing. Almost every sector was overvalued according or against its long-term averages. So I'm fine with sitting out more. If stocks want to rebound and get expensive again, I've already taken advantage of some of the lower prices at that 15% level, then at that 25% level. If they don't reach 35% down, I'm fine with still holding some cash and waiting for that next recession, because even if this doesn't do it, then the stocks are going to hit a crash eventually. Okay, they're going to hit that bear market eventually. This way, I'm able to take advantage of different levels of that sell-off, deploy some of that cash, take advantage of those prices, and still hold cash back for the worst of the worst, right? So if stocks actually do reach that 35% from peak, about approximately 2,200 on the S&P 500, I'll use 50% of my remaining cash to buy stocks again, right? And the way this works out, so the first level is 25% of my cash, then it was 35% of remaining cash, then it was 50% of remaining cash. That all comes out to about 25% of the cash I'm holding now, right? So pretty even increments of the cash that I'm putting back in the market. Then lastly here, if stocks reach 45% from their peaks, right, which is probably not going to happen, but I want to be ready for it if it does. I mean, this is a full-blown stock market crash, bear market, the worst that we've seen, 50% in 2008, 50% in 2001, pretty much as bad as it gets, right? And at 1862 on the S&P 500, that 45% from the peak, stocks would be a good deal. I want to have cash available to get into the market at these prices if that happens, right? So at that point, I'm going to use all the remaining cash I have. I'm going to buy back all my calls because remember, so that 15% level, I bought stocks with covered call options against them. I've got about 10% of my portfolio right now in covered calls. So I'm going to buy back all those calls and then invest the rest of the cash in stocks, right? So I'll probably actually take some out of bonds too and invest in stocks because 45% from their peak, even if stocks continue to fall 50, 55%, that's still a good deal, okay? These virus scares generally aren't real long-lived. If it does turn into a recession where it starts having people, companies lay off workers and it turns into a recession, it's going to last longer, obviously. Stocks are going to lose more, but it's not going to go down more than 45, 50, 55%, right? Great opportunity, and I want to be ready for that if that comes. So that's kind of how I'm positioning as far as when I want to get back in the market, how I'm going to deploy this cash. Now I want to talk about something that I saw, and I'm going to get to your questions real quick right after this because I want to answer all your questions. I want to talk about something that I saw when I was going to deploy some of that cash on Friday, trying to get back in some specific stocks or funds. And again, I'm looking at energy, healthcare, financials as three sectors that are still relatively value sectors, right? These aren't bid up as much as tech and as much as consumer discretionary, as some of these sectors that are trading way over their historic averages. But what I found is that, okay, you've got financials first. I'd love to buy maybe the XLF. Actually, I have some money in the XLF. That's the Financial Select Sector Spider Fund. So all the banks, all the financial stocks. But looking to add to it, the problem is here with interest rates where they are. The 15-year U.S. Treasury, the 30-year U.S. Treasury just hit record lows this last week. Banks can't make money at those interest rates. Okay, banks cannot make money when the long-term rate is pretty much the same as the short-term rates, right? Because what they're doing, obviously, when you deposit your money in a bank, that becomes a loan to the bank. They use that money to make loans. at those longer term rates. Well, normally when the yield curve is steep, they're paying their depositors much less, and they're collecting more on those long term rates. Well, when the yield curve is flat, when there's no inflation, and they're collecting, I think okay, so I think 30-year mortgages hit like a record low, like 3.8 percent or something, 3.5% over this last week. Banks just can't make money like that. Okay, they're still making money with trading, brokerage, and some of these others, but it's a very difficult environment for the banks. So kind of cautioned me against adding more to the XLF to the financial sector. Right. You look at healthcare. Okay, love healthcare. Obviously it's got that demographic boost, that long-term demographic change that's going to help it. But with the election, there's a lot of headline risk with healthcare. So I wasn't quite sure that I wanted to add a lot to that. Energy obviously is another one that with the price of oil has actually hit a bear market, so it's down 20% from its peak. And that's been since 2014 actually. The whole energy sector has been hurting because oil prices have come down and have stayed down for so long. So you're going to see a lot of retrenchment, a lot of restructuring in the energy companies. So not necessarily, I mean, okay, a lot of these, they're cheap for a reason. These sectors, they're cheap for a reason is what I'm saying. Not necessarily the value that you think you might be getting. So I actually went in and I did make some buys on Friday, but they were individual stocks. What you want to do is you want to look for stocks that are still doing well. They're good companies. They've just been hit by this coronavirus scare. Okay, and it's so really best of breed stocks. I can share a couple of them with you that I added. So I added Fastly. That's ticker FSLY. It's a streaming media service and content delivery company. Really excellent kind of mid cap, small cap company that is providing the services for that streaming media explosion, really. So I like Fastly. I added some shares on that. Again, these were covered call shares. So while I bought the stock, I sold some calls against them. Right, so it's gonna kind of cap your upside on that. I bought the January 2021 calls, so it gives me some time to see that upward climb in the share price. But I did collect some money against that. Give me some more downside protection just in case the market falls further and takes Fastly down with it. But I think it's a great long-term company, long-term play, so that's why I added that one. I also added Zscaler, that's ticker ZS. It's a cloud-based security company. Excellent, one of the best security companies probably right now, I think. And if you remember, actually, probably about a month ago, we covered cybersecurity companies, right when the whole Iran thing was blowing up. And that was probably my favorite stock from that group. So I added more to Zscaler. Actually added some Altria, ticker MO. This one's been down for years, and it's really hard to play these rebound plays in stocks. But at this point, it's a strong value play. It's a great dividend. I think about 8.5% dividend on there, and I think the cash flow is secure. Right? They have the cash flow. They're actually buying back stocks. So I don't think the dividend is in any real danger. So anytime I can buy a stock with an 8.5% yield and that upside potential when this thing actually does bottom out. So I think it's at least close to a bottom, and it's going to be relatively safe, safer than cash, right? Or it's going to be safe as cash. Also added to my position in Luckin Coffee. This was the fourth stock I bought, and I've had this for a couple months here. This is probably one of my favorite stocks right now. Okay, this Luckin Coffee. It's a Chinese. Basically the Chinese Starbucks. Okay, they started out as a Chinese coffee retailer. They're actually moving into their own brand of tea and vending machines right now. So kind of diversifying and kind of getting that other income source through the vending machines. And this year they're going to have more stores than Starbucks in China. So it's definitely a great domestic play there in China. I think they're going to get a little bit preferential treatment there from the Chinese. So. And the fact that Luckin Coffee has actually been relatively strong over the last week as the virus slows in China. So if you've been watching the markets, you see a lot of these Chinese names were actually doing pretty well over this last week as the rest of the markets, as the European markets, as the U.S. markets were plunging. Chinese stocks actually did pretty well. So I think you can kind of look at some of these Chinese stocks and pick them up here at a little bit lower prices. But I really like Luckin Coffee. I think you're going to be hearing a lot about that company in the next 5 or 10 years. It's going to be a huge company there in China and expand out into Asia. So those are the 4 stocks that I bought, kind of the plan that I'm doing for coronavirus. Now I want to go to your questions because I love this part of the live stream. This is what I do it for. It's just to kind of connect with you and reach out. The Luckin ticker is LK. That's Luckin Coffee. So let me scroll through here and see what I got for questions. Again, if I don't see your question, go ahead and ask it again. Because I haven't seen all these chats where they're at. Let me take a couple. All right. So again, love seeing everybody here in the community. Scott, they're deployed in Afghanistan. Awesome. Love that. Has it started? Give me a shout. Okay, people asking for shout outs, I guess. Who we got? Adam M. There's your shout out. A little late, better late than never anyway. Who else we got? Adam Stauffer, good to see you. Dread Mike 73, hurrah. Dread Mike's been a member of the community since way back when. Great member. Love seeing the comments there, bud. Verducci Man from Pennsylvania. Who else we got? Just trying to find some of these. How many portfolios do I have? So World Proximity wants to know how many portfolios do I have? And actually, this is really important because, whether you have or stocks on different sites, investments on different sites, you want to look at an entire portfolio view, right? Very important. A lot of people like to do, what's called mental accounting, and it's just a fancy word for, keeping their portfolios separate and having different risk tolerance in each, right? So maybe, they're completely risk averse in their IRA or in their retirement accounts where they have only bonds or something like that, or almost no risk, no stocks, no growth, basically is what I'm saying. And then they'll have another account, a regular account, where they're investing in like penny stocks, and just the highest risk imaginable. And it's really, besides being difficult to manage, obviously, it's really not giving them the best return they can get, and really giving them that overall plan. So what you want to do is have a spreadsheet or have something where you have all of your stocks, all of your positions and investments in one spreadsheet, so you can look at the whole picture, right? And really be able to see, okay, everything together. Where are my risks at? Where are the gaps? What do I want to invest in more? So myself, okay, so I have a lending club account. It's about $30,000 in there right now. I've got portfolios. I've got stock portfolios on E-Trade, Webull, M1 Finance. We got do our dividend challenge on M1. I've got B of A Merrill Lynch, so Bank of America Merrill Lynch. I've got some money in there. And I've talked about this on the channel before, why I have so many different investing accounts. One, it's to get free money, okay, right? I get free shares on. Well, I've got a Robinhood account that's completely free shares, right? This is completely shares that I've collected for free for referrals on Robinhood. I get for Webull, there's the deposit bonus. So when you open up that account and when you fund that account, you get free shares. You get 2 free shares on Webull for starting an account, and then they used to run a deposit bonus on that. So I get free shares, I get free cash. But also for different functions. Webull is great for stock traders because it's got that IPO center telling you which stocks are going to go IPO. It's got the earnings center, so you always know when a company is going to report its earnings, that kind of thing. M1 is a great site for that portfolio view. You can rebalance with no fees, rebalance everything automatically back to your positions. So I love that. I've got E-Trade and Bank of America Merrill Lynch accounts for the research. I get Credit Suisse reports from E-Trade. B of A Merrill Lynch obviously puts out some really good reports, research reports. And while this might make it a little bit more difficult to manage all these or to track all these, it's not that much more, and you really get the best of all worlds here by having those accounts. So World Proximity, that's what I'm looking at there. So what do we got here? Just be sure this is the actual spreadsheet. This is okay. So the spreadsheet I showed, that's the actual spreadsheet that you download from Teachable, is where I'm hosting that at. I've actually updated it since Friday. I was looking through it and wanted to add some features. So now you can change the dividend yield on the stocks. Before it was just an auto populate, right? So it's still gonna, you put in your ticker symbol, it's still gonna auto populate that dividend yield from financialmodelingprep.com. But if it's wrong, or if it's maybe not showing there, then you can change it. You can change it in there. So I updated that. Going to be lots of updates, lots of new features added to this spreadsheet in the future. So what else we got? Would you consider selling stocks now and take your earnings, invest back in the market once it's turned around? So great question from Uziel. I hope I didn't butcher your name, but would I consider selling stocks now? So again, I was pretty fortunate that I only had 30% in stocks and really had that cash and bonds set up. But what if you don't have that? What if you're sitting at that 15% loss over the last week, and you don't want it to get worse? What if you want to sell your stocks? I don't think I would. What I would do is maybe sell some calls on some of your stocks just to collect that cash, get a little bit more downside protection, but keep those long-term plays. Then I would look to those different levels, that 25% down, the 35% down, and maybe invest like that. And then use new cash. This is a perfect opportunity to start deploying your new cash, to start really saving if you can, maybe get a side hustle, maybe make a little bit extra money on the side and put it in the market, hold it in cash until you see maybe if stocks fall a little bit further. Maybe you say, okay, 20% down from the peak, then that's when I want to start deploying this cash. So I wouldn't necessarily start selling cash stocks right now, but just if nothing else, use this as a learning lesson. Okay, use it as a lesson to say, hey, when stocks do recover, I know I need to start diversifying into real estate and bonds, have a little bit of cash, and really use that to go forward. Okay, because as viruses go, usually these are short hits to the economy. Stocks end up rebounding. That's what the market's expecting now. I mean, it might get worse. It might put us into a recession, but right now the overall idea is maybe 20-25% down on the market, and then it's going to start rebounding. But if you're not positioned for it, use it as a lesson, and just going forward, always have some money in bonds to take advantage of these opportunities. What else we got? Trying to look for, I've been meaning to ask for a while, what stock screener do you use? Okay, so Logan wants to know what stock screener I use. I use a couple different ones, mostly on Morningstar. So I've got a premium account on Morningstar. It's a little pricey, about $400 a year, but obviously, I use it quite a bit for our analysis on the channel and stuff like that. They've got a really good stock screener there. But you can find really good stock screeners on just about any platform, right? I know Webull has a really good one for traders. It's a little bit more geared towards traders because it's going to give you some of those technical signals. E-Trade, I use the E-Trade stock screener a lot. And those are all free sites, free sites to use, no fees, that kind of thing. So you can definitely find a free screener. You don't have to pay that $400 for Morningstar. Where else? What else? Family emergency to attend. Oh, yep. Usually these live chats, they're recorded and they'll go up on the channel within usually about half an hour after they're over. It takes a little bit of time to process them, but if you miss any of this, then it's going to be on the channel afterwards. What else do we have? Just looking for question marks here, guys. If you got a question, please put a question mark after it so I can see that it is a okay. Any other monthlies anyone recommend to pair with SPHD? Okay, what's important here when you're looking at funds is actually go in and look at their sector exposures. Okay, I think SPHD is actually a little bit better diversified than some of those other market index funds. Last I checked, it's because it's a monthly dividend fund, and it's kind of surprising how much from tech and some of the other sectors it actually has, because tech usually isn't well represented in a dividend fund. But when you do look at your funds, okay, and you're trying to decide which other funds to buy, go to the fund page. So you just do a Google search for the fund name, so like S&P SPHD ETF or something, right? Go to the web page and find their portfolio. Okay, they're going to show you the exact percentages in each sector. Okay, Because what you're going to find, especially if you're buying like an S&P 500 fund, it's going to have 24% of the fund in technology, in one sector, a quarter of your money in one sector. Okay, so what this is going to do is one, you're going to be able to see, okay, so if I do buy that SPY, that S&P 500 fund, then obviously I want another fund that is going to give me a little bit more exposure to some of these other sectors, kind of balance out my portfolio. Okay, so maybe you buy another diversified fund across sectors, or maybe you just go in and buy maybe the some of these sector funds. So like the XLC maybe for the communication services, if that's not well represented in your other funds. So what else we got for questions here? Oh, saw some interesting articles too. If you're looking for stocks to buy during the coronavirus, kind of a neat theme, an interesting theme anyway. People were talking about some of those stay-at-home stocks, right? So you've got Netflix, you've got the stocks that do well when people stay home, and maybe so that people will see or those companies will see higher revenues. Netflix, I think they said. Obviously, you've got the streaming services, so Disney, some of those other companies that might actually do better on their revenues. Of course, Disney, they're going to get hit to the theme parks and some of the other stuff, so it might not necessarily be the great coronavirus safety net. What else we got? Till first 1Q. Okay, so I'm going to scroll down here and just take the new questions here. So just let me know if you have a question. I didn't see it. Go ahead and ask it again so I can answer it here. The portfolio, I can send a screenshot of it. We'll probably do another portfolio review. I want to do these live chats. I want to do these live streams every other week. So it'll be today, and then in 2 weeks I'll do another live stream. Probably won't be doing a portfolio review then. But I will eventually get back to those portfolio reviews, and I'll send a note out. Just be watching the community tab on the channel. That's where I announce what I'm going to be doing with a lot of these. So go ahead and send that in. Again, you can download the spreadsheet with the link in the chat here, or I'll put it in the comments when the video is up, and you can kind of see that on your own. How many core positions should one have? 6 to 8% range. So Adam wants to know how many core positions should you have, and I'm assuming. So people in the community, I love the core satellite strategy to investing. Okay, and what we're talking about here is having 65-70% of your money in funds. Okay, these large diversified funds, maybe five or six funds at the most is all you need. Funds that cover stocks, bonds, and real estate. Again, I like the BLV. I have the BLV. I have the BND for bonds. I have the VNQ for real estate, and that gives you pretty much all the real estate exposure and all the bond exposure you need almost. I mean, I've got another IRA that's completely REITs, and I love those REIT stocks. But if you're looking for one stock for real estate exposure, that's a good one. And then you've got a couple of funds that invest in stocks. So you got 60-70% of your money in these funds, 5-6 funds. I mean, you can have 10-12% of your money in each of those, and not really have to worry about your being overexposed to that fund because it's already diversified. Then you take 30% of your money or whatever's left over, that 25-30%, and just invest it in a handful of individual stocks, right? This is where you really put in the time to look at the financial statements, find those best of breed companies, compare stocks using that spreadsheet maybe, and find 10 stocks that you can follow that you really think have that upside potential. And since you're limited to just 30% of your money, 10 stocks, maybe you have 3 to 5% at the most in each. One, you're not going to get caught flat-footed and destroy your portfolio if one stock just tanks, okay? You're going to be protected on your downside there. Two, since you're only looking at maybe about 10 stocks, maybe 15 at the most, then it really limits the time you have to spend in researching and following these stocks, okay? Picking a stock, investing in a stock isn't about just hearing about it on CNBC and then going buying it and forgetting it forever, okay? You need to keep up with your stocks. You need to watch them every earnings report. Okay, what are the issues they had, and what are the issues going forward? Really, deciding if this is a stock you still want to be a part of, if this is a company you still want to be part of, and if you think management is making the right decisions. Okay, so and you can't do that with more than 10 or 15 stocks. You just can't. Okay, if you're looking at financial statements like you should, there just isn't enough time in the day. So 10 or 15 stocks. in that satellite portion of your portfolio. Okay, so you've got 5, 6 funds, maybe 10, 12% in each. You got 10 stocks, maybe 3% in each of those. What else we have? Municipal bonds. Municipal bonds is something we really haven't covered a whole lot on the channel. It's they're great for those higher tax brackets because you can get it's that tax-free interest income. So definitely something you want to look in if it's if it makes sense at your tax bracket. I actually do have some municipal bonds spread out across the U.S. One thing you really want to watch though in these municipal bonds, and it's something we've looked at in dividend stocks as well, dividends, REITs, MLPs, that kind of thing, BDCs, is that you can't chase yield, okay? I mean, you can find municipal bonds that yield 7, 8, 9%, okay, which is ungodly, unheard of for a bond. But there's a reason for that, okay? These are municipalities, that are near bankruptcy or even post bankruptcy almost in some cases in California and in Michigan. Not saying that they can't still be good investments, but you really need to look at the bond, look at the county and its financial position, and make sure that you're not just chasing those yields just because it's a high yield. Multiverse media space, another great member of the community. Good to see you here. Have you ever heard of Vantage Point AI? So the opinion, yeah, I haven't actually. I can look into it. Vantage Point AI. I'm assuming it's an AI company. So look, I can look into that. But so you own the software and want to know if it's a bad investment. Now, I mean, a lot of times that personal experience with it, if you like the software, if you think it's something that a lot of people are going to find helpful, then yeah, that can be your best bet right there. Lost my place here. Where was I? So 20,000 to invest. What do you suggest purchase to take advantage of this current market condition? Check out that, because we just covered that a little bit ago. Check out that blog post on mystockmarketbasics.com, that coronavirus stock market emergency update. I kind of tell you, what levels I'm investing in, or what levels I'm getting back to. Again, look at some of the sectors that are still relatively good value. I'd be a little bit hesitant at healthcare and financials. But maybe you dip your toes into energy a little bit. Maybe communication services, some of the telecoms. I think the telecoms are still going to do pretty well, even if the coronavirus gets worse. People are still going to be paying their cell phone plans. They got 5G coming out, which is going to be huge for the whole space. So some of those traditional telecom names would probably be something to look at right here. You think we'll have another weak? Totally lost my place again. So do you think we'll have another weak or another down drop? I think we will. I think we're okay. Will the market start to recover next week? I mean, I don't have a crystal ball, right? But like I said, I think the coronavirus is going to get worse. It's just starting to spread in the U.S. States are just getting their testing kits that actually work. So I think when that happens, you're going to see an explosion. I don't want to say an explosion, but an increase in the number of reported cases. That's going to hit the markets. It's going to hit sentiment. It's going to hit consumer spending. And yeah, I do not think that the worst is over for stocks. Okay, might get something of a dead cat bounce, especially if some of the reported cases start coming down a little bit in key areas like Japan, South Korea, Europe, if it doesn't become too badly there. Just saw a report by the WHO this morning, though, World Health Organization, that said Europe needs to prepare for a larger outbreak. They've got 1,100 cases in Italy, like we said earlier, and pretty porous borders there in the EU. So I think that's definitely going to spread through Europe, and I think we're going to see a little bit more in the U.S. So I don't think it's over. Even if we get a little bit of a market bounce. Joel Greenblatt's magic formula is a strategy. Really, I don't know Joel's. I've heard of it, but I haven't really invested in it or looked at it to know really what he's talking about. Employee defined contribution 401k, money targeted retirement. Should I invest in other funds within the plan? It's Vanguard funds. Okay, so targeted retirement funds, really easy, simple funds because they include your real estate, your bonds, pretty much kind of a whole portfolio perspective. They tend to be a little bit more expensive, so I'm not a huge fan of them because they are more expensive, and they don't have quite the rules that a lot of ETFs have on the managers. So the managers can pretty much invest in anything they want. As long as they stick to some pretty loose rules as far as asset classes, like so how much in stocks, how much in bonds, how much in real estate. Uh, so it's a little bit more power, I think, than I want to give to a portfolio manager. I like to manage my investments a little bit more myself. That said, I mean they are pretty easy to use and to invest in. So definitely not something that I would warn people or tell people to get out of or stay out of. But I like that. But yeah, if you want to put some other money into other funds, Vanguard funds are great. They're low cost, so it's always going to be a good deal with Vanguard. I mean, I wouldn't put all my money in one funding anyway. Okay, so if that's what you're asking is whether you should have all your 401k in one fund, I definitely wouldn't. Even with a company like Vanguard, I just wouldn't do it. I mean, you're exposing yourself to all kinds of risks with those portfolio managers in that fund. Whatever they're doing with the fund. So I would definitely spread it out across some other funds. Typically, those target retirement funds. Actually, I misspoke because I said they had real estate in them, but typically they don't have real estate in them. Typically, a lot of these target retirement funds, they just have stocks and bonds, okay? And maybe they're doing the 100 portfolio or the 100 years kind of thing where they take your age minus 100, and then that's how many stocks and bonds they have split up. But they don't have anything in REITs or real estate investment trusts. So definitely look in that target retirement fund. If it doesn't have any real estate exposure to it, definitely pick up some other REIT funds, some other REITs individually, or some REIT funds like the VNQ. Okay, what is your distribution between small and large cap? Which one do you prefer? Actually, you know what? I got to check to see what I've got in small and large cap. Like I said, I did this last week. I added Fastly and Zscaler. I think those are both, if not small cap, then really close to small cap. Small cap is anywhere up to usually $3 billion, which doesn't seem like a small company to me, but that's just the market definition pretty much is any company under, it's actually like, I want to say 500 million to 3 billion is small cap. Less than 500 million is nano cap. From 3 billion to I think 5 billion is the mid cap range, and then 5 billion to I think 100 billion is large cap, and then 100 billion and above is mega cap. Those Fastly, Zscaler have in small cap stocks. I'd say, I mean, it's not a big portion of my portfolio. Maybe 5 or 10% in small cap, maybe another 5% in mid cap, somewhere around there. Maybe 20% total small cap and mid cap. Because I mean, historically, that small and mid cap has done well. They have beat the market, just because you're going to have more growth, just more opportunity for growth in these smaller companies. But funny enough, the large cap companies have really been the outperformers over the last 10 years. Just like we've seen the shift from value to growth investing. So if you've been following the markets for long enough, like I have, value typically beats growth, right? Value stocks typically beat growth stocks. And that's been going back decades, 30, 40 years in data. But just this last 10 years, growth stocks have actually outperformed value stocks. So it's been a very weird dynamic in the markets. I think value just started outperforming maybe over the last 6 months. So maybe a shift there. But just the nature of this bull market and growth and size. So those large cap stocks have actually beaten. What else we got? Perhaps add some spider. From what I understand, the trend. Should you and reinvest? Should you sell your profit positions right now and reinvest at lower price? Again, I wouldn't necessarily sell out all my stocks. Most likely you've taken a hit over the last couple of weeks, over the last week or so. So I would make sure that I was positioned where I wanted to be as far as cash, positioned for maybe another leg down in the market and to take advantage of that. But I mean, we could see a vaccine. Well, I don't want to say we could see a vaccine soon because we won't. It's going to be a while for a vaccine. But we could see some nations fight this a little bit more diligently and see the cases slow down. And in which case, yeah, as long as this doesn't show through in layoffs, The second you start seeing mass layoffs from companies, that's the second to be worried. That's the second to start looking for that 35% or 45% drop. Okay, until we see that, then 15, 20, 25% I think is the most it's going to go down. So kind of look for those points. ZS is Zscaler. Yep. Have you or would you invest in a leveraged ETF? I wouldn't normally. These leveraged ETFs. So what he's talking about here, and thank you Matrix 3K for the question. It's a great question because I get a lot of people talking about these. So the SQQQ, the TQQQ, a lot of these ETFs are leveraged, right? They provide a 3x or a 2x the dividend or a 3x return is what they're supposed to do on the market. So you get an ETF that's mimicking the NASDAQ, so a tech-heavy NASDAQ, and then it's leveraged 2x, 3x times what the return is. And the way they do that is they buy derivatives. Okay, these are almost all derivatives. They're buying options and futures on the NASDAQ or on this index to get that 2x or 3x return. Well, what you get with these actually is a fund that's very expensive generally. So unless it does provide that really good return, then you're going to be paying a lot of fees, and it's not going to be worth it. Also, over the long term, they tend to underperform that index. Okay, so they don't get exactly 2x or 3x, right? So these are good funds. These leveraged funds can be good funds for trading, for short-term trading. So if you think, if you know in your heart of hearts that the NASDAQ is going to recover from here within a month or within a couple of weeks or something, then yeah, these leveraged funds can be a good trading investment, a good trading vehicle. But if you're planning to hold them long term, you're not going to get that 2x or 3x return, just because one, the loss to trading. Okay, so that manager is buying and selling those derivatives, trying to keep that 2x or 3x pretty well stable. So that's a lot of trading costs there. You're going to be paying higher expenses, and it's generally going to underperform that kind of that return. Okay, and don't forget that if it's wrong, if you're on it on the bad side. So if it's a bull fund, then it's going to be 2x the losses too. So no, I wouldn't normally go for these leveraged ETFs for that reason. Okay, so Derek wants to know, are you familiar with Squitch? No, can't say that I have. So they compete with Zscaler. Could VET cut their dividend due to... Can't help you with that. Sorry, really haven't looked at VET. Who is that? Is that Vermilion or who is that? I recognize the ticker symbol, but it's been a while. Yeah, Vermilion. So Vermilion Energy. A lot of these energy companies. Again, energy's been a bad space since about 2014. I've been waiting for it to rebound. I still think the MLPs, specifically that AMLP fund, is a good buy. It's it's diversified across those MLPs, so it's diversified. You get a decent yield, and right now value stock waiting for the rebound eventually. But as far as individual energy stocks, it's real tough because these companies have seen that those energy prices come down so much. Not only are they facing recession fears with the coronavirus, but travel is one of the hardest hit in this virus. So, obviously the airlines aren't using as much jet fuel. If it gets worse, people won't be driving as much. So yeah, haven't looked at Vermilion for a while, but I'd be cautious on energy. What do we got? What do you think about Seeking Alpha? Good question. Time to kill. I actually started writing on Seeking Alpha in 2012 when I first started kind of transitioning from full-time analyst and full-time job to my own online assets. So I was writing for Seeking Alpha, and you can get some really good analysis and really good insight there. The problem I have with it, and this is kind of the pot calling the kettle black, because I love everyone here in the community on YouTube, and I think it's humbly I think it's a great channel to follow, but it's hard to tell. You go to all these channels on YouTube, you go to all these analysts on Seeking Alpha, and there's really very little vetting process. Okay, so I mean, you don't know what kind of analysis you're getting, whether it's even factually correct sometimes. As I said. So I was talking about this No, actually, it's a video I haven't actually released yet. Video I was working on last week, filming last week, talking about some of the scams that are coming up in the market. And I get approached regularly. Okay, so we're talking at least 2 emails a week asking to join an investor network, right? And basically, what these networks are, these are websites set up to recommend penny stocks, is what they usually are. And then they have this network of analysts, right, on Seeking Alpha, on YouTube, blogs, wherever they may be, that talk up these stocks, that receive. So these networks, these websites typically have, a couple of people writing analyst reports, right? They're not really analyst reports, but they talk up a stock. They pass these on to this analyst network or this content providers network, and they talk up the stocks. Hey, I got this great analyst network or report from this network I'm a part of, and it's just a pump and dump scheme, basically, is what it is. Now, obviously, I'm not saying that's what Seeking Alpha is or anything like that, but there are. I mean, I have seen when I was writing for Seeking Alpha, a lot of these, a lot of these channels. I can't remember what you call them. Basically, people on Seeking Alpha that are kind of involved in these. And it's just kind of hard to make that distinction sometimes between who you should listen to and who not. So yeah, I mean, like I said, there's a lot of good analysts there, YouTube, wherever, but you really have to be cautious about who you're taking advice for. If they're telling you to trade in and out of stocks and which stocks to pick and all that kind of thing, you really gotta caution yourself and hesitate and wonder where their motives are. Okay. So yeah, I'm sorry, probably not a great answer, but that's really how it is. Great live stream. My question is: if you have gross stocks is up 40, if your gross stock is up 40%, should you sell all of it or hold a position, i.e., Shopify? Great question, and that's always, that's always whether you're in it for the long term, what your short term or long term goals are for a stock. This is part of the reason why you only want 10 or maybe 15 individual stocks at the most. Okay, you really need to be following a stock, be reevaluating your target price on it. Could the stock go further? Generally, I would say just hold on to them. I mean, one of the biggest mistakes that investors make is selling their winners too early and holding on to their losers. Right? They don't want to book those losses, so they sell their winners, booking those profits so fast, and then they hold on to their losers and all the way to the bottom. So, I mean, something like Shopify, just for an example, I mean, is that going to be a part of the digital economy going forward? What is their business model like? Are they experiencing site growth, so are more people coming to the site and growing their site's revenue and that kind of thing? So it's really got to be kind of an ongoing thing. So I definitely wouldn't say just because it's 40% up to sell it, because I mean. You look at a great example of Netflix. Okay, the best performer of the 2010s, something like, I want to say like 486% over that period. I think it was more, actually, a lot more. And if you would have stopped at 40%, you'd be kicking yourself all the way through the decade. So it's really got to be something that you watch and believe in the company and spend the time to follow it. What are some buy and hold forever stocks you think are approaching good values this week? I mean that's a lot of research I haven't done for a little bit. I would say like the ones I picked this week that I put on Altria, not necessarily hold forever because I don't know where the whole regulatory and environment is. Obviously they've got a product that people will kill for. And as bad as it's been over the last few years, then I mean I think it's a company that's always going to have a product and going to have a product for very long. Obviously they've got the cash and the financial flexibility to move into those new products as they can. Great dividend yield, long paying dividend company, and I think that's one you can hold for a long time. Might go down a little bit more, but I think it's close to a bottom. That Zscaler or some of these cybersecurity stocks. Obviously, it's going to be a theme decades into the future, something you can look at. Some other companies that I've looked at. Actually, I was going to put on a position, add to my position in KHC, so Kraft Heinz, another very beaten down stock even before the coronavirus. Warren Buffett still owns like 20% of the company, so obviously he's pushing for profits. A company that's got some great brands. and even despite their management troubles, is something that is going to be around forever, and I think it's a great value at this point. What else we got here? Aerospace and Defense ETF. Ah, yes, that's actually. Thank you for reminding me. This who's that? Vishvesh. Sorry, I can't pronounce your name right now. But great question. It's actually another one that I looked at over this last week, and what worries me there, so when we did our sector videos, sector investing videos, I really like the aerospace and defense market. I think, obviously it's something that we're spending more on defense, we're spending more on, the space race is just starting. But it kind of, the election risk kind of worries me, okay? Because, and I don't want to get political here, but, depending on where the election goes, we could see a lot lower defense spending. But that's actually not even the biggest worry that I have for the aerospace and defense sector right now. Okay, obviously all these airlines are really going to take a tumble. I mean, they've already fallen quite a bit, but I don't think the worst is in for the airlines yet. So I want to wait to see those settle down a little bit before I jump back into this aerospace and defense fund or industry or sector really. What else? What else do we have? What about free floating adjusted market cap ETFs? That's a lot to get into. So free floating, I'm not quite sure which ETFs you mean here. Free floating adjusted market cap. So basically, it would be the manager has more discretion as far as what market cap stocks he trades in, I guess, or picks up. I'm not quite sure which funds you mean on that one. Herd growth outperformed dividends. Coca-Cola. Any plans to top growth stocks for 2020? That's actually a really good. Punky Brewster. Love the name there. Yeah, actually a really good idea for a video. I'll start putting something together so top growth stocks for 2020. So I'll look at that. What else? Derek Scott says if you could add someone more Lockheed, GD, L3 Harris. Okay, so not a question I don't think, but yeah, some companies in the aerospace defense theme, and yeah, actually, so Lockheed, General Dynamics, and Northrop Grumman were actually three stocks that I was looking at last week. So not necessarily that entire aerospace and defense sector, because I think, like I said, I think the airlines are going to hold that back a little bit. But I think you can definitely start looking at some of the defense names. Watch the election risks, though, because obviously that's the area that's going to get hit depending on which way we go with the election. Bank of America is going down. Do you think it will go back up? Okay, Bank of America is actually another one I looked at. I was looking at financials. Like I said, I was looking at Bank of America and Wells Fargo. I know both of those are good companies to hold for a long time. They both had their problems in the past, but again, it is really hard for a bank to make money in this interest rate environment. Okay, with long-term rates where they are and where they are likely to be in the near term, it's really going to be hard for banks to make money. So yeah, their value. It's definitely a value sector, but value for a reason, because it's got that hanging over it. So I think I'd wait for a little while to add more to my XLF or any of those bank stocks. So we are an hour and a half in, and I love these live streams. I appreciate it. I love having this back and forth, but I got to go lift. The gym closes at 4 on Sundays here, so I have got to go. Got to get that in today. I appreciate it. Again, I will post that spreadsheet link in the comments below to this video. Make sure so you can download the copy there. If I didn't get to your question, add it to the comments, and I answer all the comments that I get. So I'll answer your questions in those. And again, watch for those videos this week. Got some great videos, including that dividend update on Friday, that March dividends, that stocks that we're going to be adding. And actually, I'm going to be looking at my own portfolio, seeing where the gaps and the risks are with that spreadsheet that we used, and using that to add some of the stocks for our March dividend update. Again, I appreciate it. I love having these live streams, and again, I'm going to try having these live streams every 2 weeks here on the channel.